Well, we do these calls on a weekly basis, almost always on Thursday, except for the first week of the month, because we want to capture that Bureau of Labor Statistics employment report. And we got it this morning, and it hurt us. So let's talk about how much on today's video. So let's dive right in. Mortgage News Daily. This is our best daily gauge of what interest rates are doing nationally. Has a 30-year fixed rate average conforming loan at 7.15 today. We were at 7.03 yesterday, y'all. So we're up 1/8 of a point in a day, which is significant, and it's all due to today's unemployment numbers. We're going to get into those in just a minute. 30 days ago, we were sitting at 7.19, but remember, we had seen rates really nicely improve over the last week. Today's jobs numbers took the wind out of those sails entirely and took us back to pretty much the highs of the month. So here's what was in the report. So we're going to dive in. And as we have seen repeatedly in this report, it's a mixed bag. So we had expected 185,000 jobs to be created. We got 272,000 new jobs. So that's considered a very healthy labor market if you look at just that number, and sufficiently so to be inflationary. So that's the piece that the bond market looks at. They view that as another piece of evidence to suggest that the Fed is not going to be stepping in to help us anytime soon with jobs numbers like that reporting. So that's why the bond market reacts negatively to these numbers. It's important to note, though, that the Bureau of Labor Statistics uses a birth-death model in calculating this number. In other words, it's an extrapolation. It is not an actual survey. The household survey, which is also part of this report, which was released today, actually calls households to check their employment situation. And then they extrapolate that sample out to get us the unemployment rate, which actually ticked up from 3.9% expected to 4%. So the household survey is showing job losses. The birth-death model used by the BLS is showing job creation. So we have this divergence in the report. I will say, though, the headline number is what's ruling the day in the bond market. It's kind of a follow me deal. That headline number is what folks trade on, even if the internals may undermine that number a bit, as we're seeing here. There is a piece also in the report. You want to see wages coming down or staying stagnant when wages are increasing. In a tight labor market environment, that is itself inflationary as well, because those costs get reflected in whatever that company produces. We were expecting that number to come in at 3.9% year over year. This is the percent of increase in wages year over year, came in at 4.1%. So that was hotter than expected. That is inflationary. That's why this ADP component, this household survey rather, did not help us more than it might have otherwise. So headline number very strong on the employment numbers, hurt us pretty badly. What did it do with regard to the outlook for what the Fed might do? Well, for that, I look at CME, FedWatch tool that we've talked about on a few previous calls. They have a 91% of a no movement at our July meeting. Y'all, we're not going to see the Fed do anything at the July meeting, even though the European Central Bank and the Chinese Central Bank have both moved this week lower. I don't expect the Fed to follow suit until September at the soonest. CME has the Fed tracking at a 51% likelihood of a cut in September, a 66% likelihood of a cut in November, and an 87% likelihood of a cut at the December meeting. So still looking at the fourth quarter of this year as a likelihood for the Fed to start moving and easing following other markets around the world. Also keep in mind, we're going into an election year, y'all. Take from that what you want as far as making things a little more favorable for the incumbent side, as seems to be the case based on history. So in any event, hope this information, y'all, is helpful. A lot to cover in today's call. Not great news on today's headline number, but we'll see what next week brings us. Normally we see a bit of a pullback when we see this much of a movement as the market digests some of these internals. So we'll keep an eye on it. We'll report back next week. We'll talk to you next Thursday. Be blessed. Stay safe. Talk to you soon.